Hi, Paul Heinze with Kutchins again for episode number 2 of Preparing Your Company for Sale. Al is a renowned partner in a company that is expert in CPA services from beginning to end, long established, highly regarded and respected. If you want somebody on your side in preparing to sell your business, best you get acquainted with Al. In the hundreds of transactions that we've done, there's never been an issue that hasn't been handled properly and thoroughly in Al's firm. We're going to talk this morning about getting ready, preparation, having to do with documentation, all the different things that you should be getting involved in. I'm just going to let Al begin where he wants to begin, because this is important and we invite your replies. So Al, thanks for setting aside time again. Welcome back. Please take it from here.
Thanks, Paul. It's great to be able to share ideas and strategies with you and your listeners in a topic that is very near and dear to both of our hearts. So in the last episode, we talked about some of the softer issues and going to the thought process of selling your business, dealing with family members, partners, your spouse, and things that will happen resulting from the sale. Today, assuming that we didn't scare you off last time, wanted to start focusing on the preparation process for the sale. And in the ideal situation, this will start 3 to 5 years prior to the goal sale date. And some of these items you might have already put in place, particularly if you've gone through ISO certification or any of the other technical certifications, because these are really best practices. And if you're selling or not selling, you really should consider implementing the strategies and procedures that we're going to highlight in this session. So the most common problem that we encounter is that owners use the business as their personal expense account. And, we see travel. I one time saw a wedding and cost of goods sold, things that are way beyond what we would consider normal fringe benefits. It is expected that your vehicle is there, that there's a reasonable amount of meals and entertainment, that if you're at a convention, most likely your wife is going to accompany you, and there might be some vacation time either preceding or following. But it's really when you start becoming a pig and stuffing so many expenses, putting individuals that are doing no work in the business onto payroll so that you can avoid having to make any gifts to them to subsidize their living expenses. And this is important for at least 2 major points. One is when a potential buyer starts looking at your books and records and seeing all of these expenses, their antennae are going to immediately go up and say, what else isn't correct?
Yes.
And the second is somewhat tied to it, is that most sales, the values are on some formula to EBITDA. And so you might be getting some potential tax savings by bearing these expenses, but you might be giving up a lot more in proceeds on the sale than you've saved in taxes.
Yes, indeed.
So one easy way to solve the issue is to increase your salary to cover these expenses and keep your income statement clean. And in the sales process, there's usually what's called some normalization adjustments. So if somebody in your position should be earning $300,000 a year and you're taking $450,000 a year to cover all these extra expenses and keep the income statement cleaner, then that would be an add back in the EBITDA presentation. The same thing is if you're driving a very expensive car, and a more modest car would be a normal benefit. That would be an adjustment. If you're bearing your country club dues that aren't deductible anyhow, that would be another example of an adjustment that would be made in normalization. But cleanup doesn't only impact the income statement side, it also impacts the balance sheet. And I've often seen large loans to owners or other family members that they really have no intention of getting repaid. And the potential buyer isn't going to count those as assets anyhow, so they're going to be knocked out when you do your working capital computation. So you might as well get them cleaned up. Yeah. The same thing would apply to advances to employees. I've had situations where employees have left in prior years and the loans are still on the books. If you're not going to pursue collection activity, you should do a 1099 and treat it as an expense and income to them and get it off the books. Two other areas that we find are important, and both of these really have operational significance also, is how realistic is your inventory valuation and how often are you turning it? So is the inventory too high? Use the preparation years to reduce that inventory, get rid of stale, slow moving or obsolete stuff and convert it to cash. I once worked with a turnaround guy, and this company built cranes and they had $6 million of inventory, but not enough to build any one complete crane. They were all just excess parts that had accumulated over the years. The same thing is you need to look at your receivables, your accounts receivable. How quickly are you collecting your money? Are there old ones that need to be written off? Because if you're profitable and you're not using a bank line of credit, you don't really go through the list every month and see which ones are ineligible. But often this is a wealth of opportunity to convert assets into cash. And the other point from an operational standpoint, as our recovery might be slowing, and I don't like to use the R word, but as business slows down, you really should be staying on top of the receivables even more than in good times, because one of your customers might easily fall into trouble, and you'd be a victim of a write-off. So these are all points that you should be looking at, but also you need to document each of the procedures, your collection procedures on accounts receivable, your credit issuing procedures to customers. How do you pay your bills? How do you value your inventory? What are your policies in making advances to employees? These are all processes that you need to document, and so that if you lose an employee, or when you sell the company, your buyer will know exactly what to do and such. And to protect yourself, you should also be cross-training your employees. So this would be a good opportunity to have them pick up the instructions cold and go through the process and make sure that the documentation is accurate and includes all the steps and procedures. We just instituted a new client acceptance procedure here, where anybody bringing in a new client has to submit it to the executive committee before it's accepted. We want to make sure that we have the expertise to properly service the client, that the anticipated fee is appropriate so that we can professionally service them, and that the background of the client is one that fits into the profile of businesses we want to serve. And things like that are easy to check out today just by doing a Google search or LinkedIn or any of the other resources out there to see if there's many negative comments about the business and the owners. So this is important, as I said, not only if you're selling, but to make sure your operation is running smooth and taking advantage of best practices.
The
Yes, Paul.
The implementation of what Al is talking about has many facets of benefit along the way. The discipline of some of these procedures can be easily guided when explained, and his support people can certainly aid in that. The ultimate goal of what we're talking about, the ultimate objective of why we're doing the getting ready to sell your business, is so that you optimize the end result in terms of price and benefit. We're going to get into a number of other aspects, but once you get consistency and take the advice of reporting and reducing unnecessarily unproductive expenses, and you understand what the role of EBITDA is, which is earnings before interest, taxes, depreciation, and amortization, and that figure with a multiple is reviewed, calculated, and even suggested by a potential buyer. When you start talking with buyers and it is a cluster of maze and difficult things to track, and talking about cousin Eddie, who works here on the weekends, and all of these exceptions to normal, as Al said, standard, acceptable, good practices. Once you get through all of that and run cleanly, your business will run better. And chances are you're going to get more money for your business at the time of sale. As you reduce debt, as you increase efficiency, and as you do things properly. It doesn't take any brains to sell a company for a low price and leave money on. None, no brains.
Paul, where are multiples averaging these days?
They go between 3 and 5. Mostly there are exceptions, and those are governed by not only the length of time in the business, but the special characteristics of the business as it sits within a given industry. For example,
So every dollar of profit can equate to $5 increase in selling price. So your return on investment is pretty solid.
exactly. If you think of it in exactly that light that you're talking about, investment, where are you going to go and get standard investment rates that are high? You're in a stock market environment that has volatility written all over it. Why not invest, trim, make efficient, clean up, and energize your business, even if you're going to be selling it within the year, within 3 years, or within 5 years? It is doing you a great favor. And then you can prepare for the tax implications. You can prepare for all sorts of other aspects that we'll be covering in episodes yet to follow. Pay attention to what Al is saying. Listen to the tape again. It's very, very important that you apply these areas of implementation, regulation, and just plain common sense.
And as Paul and I suggested, if you have a ramp-up window of 3 to 5 years, you're able to implement these processes in a methodical manner, because change is very hard for any organization, and to try and cram a bunch of changes is very disruptive. So, you can do what I call the salami theory. If you put a big sausage on the table, it's not very appealing, but if you cut it into thin slices, it seems to disappear pretty quickly. So, if you look at these in small slices, you'll feel that you've accomplished a lot and in putting them in place.
Yes, you'll be running your business more efficiently, more in a more satisfactory way. You're not going to be sitting alone, letting the impulse that's unchallenged and undiscussed guide you and drive you into making decisions that ultimately you wind up either pay me now or pay me later, as far as taxes or expenses or a lower price for your business. Let's give the folks a little snapshot, Al, of the methods of how, just a couple of definition words of how we're going to be talking about the ways that they can sell their business.
So there's a whole handful of different methods in going about selling your business. The first is, do you have family capable? And that's an important word, capable family members looking to purchase, to buy you out, or key employees. If you have great employees, you might want to consider an ESOP. And you can use an excellent traditional broker like Paul and his partner Joel, and they bring a wealth of knowledge in assisting in preparing the business for sale to maximize the EBITDA. They also believe in making the business the most saleable and doing what's necessary. And, in future episodes, we'll talk about the actual work of making your business really look attractive to a potential buyer. And it could be simple things like putting in more energy efficient lighting in your factory so that it's not only better for your employees, it's when somebody walks in, it looks really contemporary, often a fresh coat of paint. You got to think of it very similar to what you might go through in selling your house. You want to make it really attractive when a prospective buyer comes in. And, we're going to talk about both real things that need to be done on the financial end and cosmetic things that need to be done to make the business more attractive and hopefully increase that multiple of EBITDA to the top end.
If you have particular questions or areas of concern or unique situations that you'd like to talk privately about, call Al, call me, talk with us, give us suggestions, give us questions that you'd like us to answer in subsequent episodes. How may our listeners get in touch with you, Al?
So my direct phone number is 847-278-4335. And my email is akutchins, KUTCHINS, at KRDCPAS. And we're happy to have complimentary meetings with anybody listening to the podcast, either virtually or in person. So,
thank you for listening with us and joining us. We're here so that you're not going to leave money on the table when you sell. Please keep that in mind. And all of the decades of our experience, they've all been focused on leaving our customers and clients better than we found them. You've been listening to the second episode. You'll be seeing the third episode coming real soon. Thank you for listening. Enjoy. Pay attention to your business. See you next time. Bye for now.